All right, welcome to a brand new week ahead, everyone. Before we get stuck into the calendar for the week ahead, let's just quickly take a look at where we finished last week across the major asset classes. For the dollar, it was a pretty solid week last week. We finally saw the dollar index manage to break above that very key level of resistance between the 93.30 as well as that 99.30 and 99.50, which basically kept the dollar index at bay since the early parts of June. We were able to break above that level. There was a couple of key catalysts that pushed the move higher. The first initial one, of course, was the FOMC policy decision, where the Federal Reserve came out a little bit more hawkish than what the markets had anticipated. Coming into the decision, the market was expecting the bank to solidify the idea that we're going to get another rate cut in December. Instead, though, what Fed Chair Powell explained is that, listen, that December expected cut is not a done deal by any means. And he basically explained that the cut that they did last week was just a type of insurance-based cut. And going forward, because they have that huge lack of economic data, there's a lot of dissension among the FOMC members right now. Some of them called for a 50 basis point cut, which in my opinion was more politically motivated. And then, of course, there was others like Schmidt, who actually came out saying that he voted for a hold, saying he didn't think they should have cut rates because they don't know where the data is currently sitting. Now, as a result of that hawkish shift from the bank, we did see rates pricing price out a little bit of those cut expectations for December, but the markets are still sitting at about a 69% probability favoring a cut versus a hold. Now, that means for the upcoming week, and we will touch on that in a second, central bank policy comments or comments coming out from the FOMC will be absolutely critical for the week, but we'll touch on that in a second. Apart from that, we also had some positive news coming out between the US and China in terms of that trade truce that was announced, and all of that basically just conspired together to finally see the dollar push above that very key level of resistance. Now, I am currently still long the dollar at this stage. I'm not sure how long I want to be holding this position, to be honest. It is one that has been running for quite a while. I do think there could be more upside in store for the dollar. The initial target for me for the first two units that we took off was that 99.30. Now, we got there a couple of weeks ago. I'm just going to let this one ride a bit and see what we can squeeze out. It is currently at break even. I will most likely just be moving that stop up throughout the week as we start pushing above, especially now that we've cleared that very key level of resistance. Apart from that, gold, very popular symbol over the past couple of weeks, especially when, we hit all-time highs, which seems like every single day for such a long time. And then all of a sudden, as is the case with most of these aggressive trends, things got very ugly very quick a couple of sessions ago. Now, there's been a plethora of reasons explaining why we had to pull back. The most likely one was that margin increases that we saw coming out from the CME. Apart from that, though, this is the cycle, right? This is what you expect to see when things get as aggressive as it was. I mean, the move got parabolic at some stage, and that's what you normally have the risk. You run the risk that you have these huge, massive spikes or moves to the downside. And then all of a sudden, when a lot of bag holders are getting in at the wrong time, the move reverses aggressively, and that has obviously caught a lot of people off guard. Now, where are we currently sitting when it comes to gold? Price momentum is still bearish when it comes to gold, not in the very long term, of course, but in the short term, definitely we broke below that very key 1 month price momentum last week that we highlighted. We had a very big flush to the downside on the back of that, and then we kind of just traded sideways to upwards for the majority of last week. I would still expect more downside pressure for gold. It's not something that I have conviction to trade. Just want to make that very, very clear. But looking at this from a pure momentum point of view, without looking at all of the fundamental reasons, price momentum still looks pretty bearish leaning here when it comes to things like gold. Now, in terms of equities, there were so many back and forth things when it comes to equities. We had obviously the FOMC, which should have been more negative for equities as it came out more hawkish than expected. But at the same time, we also had the trade truce between the US and China. That was a positive. So you had one positive, one negative factor driving equities. And then in terms of earnings, my word, what a messy show. You had things like Amazon, which was up 13% at some stage on the back of its earnings. Apple also did really good, but at the same time, you have those other big tech companies like Meta pushing lower, Microsoft pushing lower. So equities had a really tough week last week. A lot of back and forth, a lot of positive as well as negative catalysts. We did finish up on the week, but just marginally so if we incorporate that gap open that we had coming into the week last week. Now, in terms of the week ahead, what do we need to focus on? As we mentioned previously, central bank speak, specifically FOMC talk, will be absolutely critical this week, because remember, Fed Chair Powell already told us last week that there's a lot of dissension among the ranks right now. Policymakers just don't know what's going to happen because they don't have economic data, right? And you can see here, we've got just a massive amount of central bank speakers coming up from the FOMC next week or this week ahead. It's going to be critical for us to watch, right? All of these things can be market moving. If the majority of them is leaning more dovish, what would you expect to see? That means if the majority of them is expecting a cut in December, that could see some upside in gold, upside in equities, downside in the dollar. If the majority of them, though, comes out and they support the case of holding as opposed to cutting rates, we could expect further upside for the dollar, further downside for gold, further downside for equity. So that is definitely a key one we'll need to be watching in the week ahead. And do make sure to just check out what was previously said by these central bankers, right? Knowing what they said previously just gives you an idea of whether what they're saying today or this week ahead, whether it is different from what they previously thought, either more hawkish or more dovish. Now, apart from central bank speakers, we also have some economic data coming out for the US. Remember, the major economic data is still delayed. We would have gotten the NFP data on Friday, but that's not going to happen. What we do have, though, is those data points that's released by external agencies, not government agencies. One of them is obviously the ISM manufacturing. That is coming up on Monday. That one, as well as the services number coming up on Wednesday, could be very interesting because it's some of the very rare economic data that we're actually getting from the US. And in terms of possible impact there, it's obvious, right? Apart from that, we also have the ADP, which has been growing in importance over the past couple of months now. Firstly, because it was the one of the measures that most accurately reflected those big revisions that we saw in the NFP data. And secondly, it's the only real jobs data that we're getting. The ADP has actually told us last week that they will now be offering like weekly snapshots for jobs data as well, because things are just very, very blind for the Fed. So both the ADP as well as the ISM data points will be critical for us to watch. And again, the impact there is pretty obvious what we would expect. If the data comes in really, really bad across these measures, we would expect downside for the dollar, we would expect upside for gold, we would expect upside for things like equities. And if the data comes in very, very good, basically further pointing to the possibility that we might not get that cut in December, we could expect further upside for the dollar, for the downside for gold, for the downside for equity. So pretty simple in terms of what we would expect to see and what we're watching for those data points. Now, in terms of other events that we also have coming up, we do have the RBA policy decision coming up on Tuesday. Now, this one is going to be interesting. Markets are looking for a very quiet one, actually, from the RBA, with all major forecasters expecting the cash rate to stay unchanged. Let me just quickly show you guys. There's a 92% probability that the cash rate stays at 3.6%. And that view is unanimous across market participants. And that is for a very good reason, because last week, you guys will remember we had the Q3 CPI data. Geez, and in terms of this data, guys, it came in much hotter than anybody anticipated. We had the weighted CPI month-over-month measure printing at 3.5%. That is 0.5% above the bank's 2 to 3% target band. We also had the very important trimmed mean CPI. That's the bank's preferred measure of inflation, printing at 3% right on top of the bank's upper 2 to 3% target band. Now, this upside surprise, it effectively killed off any near-term cut expectations that was priced in for the RBA. I mean, if you take a look at the curve right now, the first cut is fully priced in only by September of next year. So that just shows you and if we take a look at a week ago, right? A week ago, the market was still pricing in close to 50 basis points worth of easing. You can see that we were at about a 70% chance of a cut for the November meeting, which is obviously the one coming up this week. And the current one, you can just see how aggressive the markets went from pricing in cuts, now completely just pricing in holds. And that is all on the back of that CPI data. Now, what are the markets expecting as a result of this? The market is expecting the bank to basically just strike a very data-dependent and cautious tone, noting that inflation remains much more sticky than what they want to see. Services prices are obviously still elevated, and the bank will need to see several quarters of softer data before they want to potentially ease again. Now, what's interesting is that we saw a very ugly labor print, of course, a couple of weeks ago, right? That was the main trigger for why the market was pricing in a higher probability of a cut just a week ago, was because of that unemployment rate jolting up to 4.5%. But last week's CPI data, it completely outweighs that recent softness that we had in the labor market. And we would assume that the bank will prefer to wait now for confirmation that inflation is actually moving back down, as opposed to, just aggressively wanting to cut rates because of one bad jobs number. So in terms of possible surprises then, I think the biggest surprise, if we get one, will come from a dovish leaning statement from the RBA. Perhaps if they nod to that softening labor market, or maybe nodding to the slower consumption that has been a problem for them. I think that's a low probability event, but if they were to come out and they say something like, hey, it's one CPI print, we're not going to be too focused on it. Our previous plans for easing marginally or gradually is still in place. That could obviously be a good trigger to look for some downside for the Aussie, but I doubt whether we're going to get something like that. Conversely, if they come out much more hawkish than what the markets are currently expecting, that can obviously be, that could create a possible trade to the upside for the Aussie. But, with the markets already repricing the curve so aggressively, they would have to come out really, really hawkish, I think, to surprise on that front. If they completely push back against any idea of easing, even towards the middle of next year, then that could trigger some short-term upside for the Aussie. But like I mentioned last week, I am cautious of chasing the Aussie higher in this scenario, because we've got slowing growth, we've got a slowing labor market, and now you've got rising inflation, which is going to keep rates higher. It's just not good news for the economy. So I would be playing that one a little bit cautious. I did get into a Aussie Kiwi short on the back of that CPI data. But as we get closer towards the RBA, I would most likely just try and get out of this one for a small loss. We'll see where we open up in the week ahead, but I would like to get out of this one as close to break even as I can, and then assess the situation after the RBA to see if there's any possibility to trade that after we have the decision. Now, the other policy decision we've got coming up in the week ahead is, of course, the Bank of England. Now, when it comes to the Bank of England, similar to the RBA, the markets are not expecting this bank to do anything in terms of rate decision. It is expected to remain at 4%. Yet another wait and see meeting, because the MPC has to weigh mixed signals from the recent data, and obviously they've got the looming autumn budget coming up on the 26th of November. They would most likely want to wait for that before they want to pull the trigger. So with the hold, the most likely outcome, if we just go to policy expectations here, you can see that there's about a 67% probability of a hold. With that, the most likely outcome, the short-term focus, as usual, will be for any potential vote split that we get, right? So how many people are voting on the MPC are voting for a hold, and how many are voting for a potential cut. That'll be a key focus. Obviously, the more aggressive that vote split, the better the reaction will be. But again, at this stage, it's unlikely we get any big shifts from them, because they would want to see, even though they get data, they are also flying blind, just like the Fed, because they would want to wait and see what happens to the budget. Now, the market's confidence or greater confidence in a hold is really quite simple right now. It's because of inflation, guys. If you take a look at where inflation is currently sitting, even though inflation has moved a little bit lower than what the markets had anticipated in the recent data, inflation is still way too high, right? We had headline inflation sitting at 3.8%, which is still nearly double the bank's 2% target, right? So it's just way too high for the bank to get comfortable cutting rates here. Wage growth is showing signs of slowing. So too is services inflation. But again, at 4.7% for services inflation, it's just way too high to justify aggressive cuts right now. That's why policymakers remain cautious. That's why the markets remain cautious. And you can see here from a rates point of view, the markets are only pricing in the first full cut by February next year. And I think that makes a lot of sense, because that gives them a lot more inflation data to work with, a lot more labor data to work with, and more importantly, it gives them that they will know what's going to happen to the budget by that time. So with that in mind, what could potentially trigger some volatility? The obvious and biggest surprise from the bank this week will probably be a surprise 25 basis point cut. Now, it sounds crazy with inflation this high, and I think that's an unlikely event in my view. But interestingly, it's something that quite a few investment banks have noted as a slim but not an impossible risk for the week ahead. You can see that currently rates markets is pricing in a 30% chance of a cut. Now, if you look at inflation, that feels a little bit too aggressive, right? I would have thought the markets would be more comfortable with a hold. But there's a couple of participants that's been highlighting that, hey, listen, even though they would probably want to wait for the autumn budget, they know that growth is slowing. They know that the labor market is slowing. And whether the budget includes tax cuts or not, and whether it includes spending cuts or not, that doesn't really change the situation in the UK. The situation remains bleak economically, so one could argue that cuts are needed regardless of what the budget's outcome is in November. So that's quite interesting. I thought the fact that the markets, are leaning 30-60 or 30-70 felt a little bit too aggressive in terms of cut expectations, but it shows you there is a lot of uncertainty. And obviously, if we were to get a cut without that being fully priced in, that could see immediate downside for the pound. Conversely, though, because the markets are pricing in about a 30% chance of a cut, if we were to see them following through with a hold, even though that is the higher probability, that could see some short-term, maybe just short covering for the pound. We've had a lot of downside in a very short space of time. I mean, pound dollar just fell like a complete rock last week. Big moves to the downside, reaching those prior levels of support around that 131.50 psychological level, 131 psychological as well. So from a pure positioning point of view, if we do manage to see a hold, it might just see a little bit of short covering to the upside for the pound, just purely because the markets are actually pricing in a 30% chance of a cut. Now, if we do get a hold, the focus will immediately fall to the vote split, meaning how many participants are voting for a cut, how many are voting for a hold. I think with a hold, we probably want to see an aggressive vote split, meaning 8-1 voting for a hold. That would be seen as a hawkish trigger, obviously seeing some potential upside for the pound. Vice versa, if it is a hold, but it is a 5-4, meaning 4 people actually voted for a cut, that could actually see some additional downside pressure playing out for the pound. So that is something worth watching. But again, it's not something that I think it's going to be a non-event, but obviously, we'll need to just pay attention to that. Now, apart from that, we also have some labor data coming out from New Zealand. Look, I'm not expecting a lot from this. It could be interesting because the markets are pretty bearishly priced when it comes to the Kiwi as well as the RBNZ right now. The markets are expecting that the data will continue to show a softening economy, but not collapsing labor market. Consensus across the board is expecting the unemployment rate to tick up from 5.2 to 5.3, and they're expecting a meagerly job growth of 0.1 versus negative 0.1. So modest deterioration in one and slight improvement in the other, but enough to remind the markets that the RBA was justified to cut rates again at the prior meeting, and potentially there's another cut still coming up. If you take a look at cut expectations, you can see there's about a 21 basis points priced off easing for the November meeting, and that's about an 85% probability of a cut. Now, Some of the recent data that's come in has shown that firms have been cautious on hiring. As consumer spending softens, we've got migration-driven population growth obviously boosting the labor supply as well. Most investment banks still see the jobs data as a key piece of evidence that domestic demand is basically easing, and for the RBNZ to just, again, push the OCR a little bit lower in the upcoming meetings. Now, in terms of possible surprises then, what could we look for? Look, a softer than expected print will just reinforce the expectations for further easing, right? And if you take a look at 21 basis points already priced in for November and 34 priced in by next year, July, if it's a really, really, really ugly print, that could potentially see the market starting to price in a whole nother cut for next year as well. And that could potentially create some downside for the Kiwi. But again, a lot of bad news has been priced in for the currency. I think the more exciting one to trade would actually be a surprising beat to the upside, right? If we were to see the unemployment rate ticking down instead of up, if we were to see a solid jobs growth of, let's say, 0.3 or 0.4 and upside in labor, in the labor index, that could be far more interesting, I think, to trade for the Kiwi, and then potentially looking for some upside for the currency just because there's so much bad news already priced in for it. So that is one that I'm watching, but again, not one that I'm expecting a lot from. The other potential one we've got coming up later in the week on Friday will be another batch of Canadian labor data. Now, this comes on the back of the rate cut that we had from the BOC last week. If you take a look at market expectations right now, you can see markets are expecting another pretty bleak print of -20 for labor and for the unemployment rate to tick up from 7.1 to 7.2. Now, look, this isn't a positive backdrop. You've got labor demand that's weakening. Job losses have been increasing, especially in those trade-sensitive sectors. Wage growth is slowing because businesses are more cautious about adding more headcount, right? They don't know what's going to happen to the trade situation. However, you know, the BOC, even though they cut rates, they did say last week that they think that they are done for now, right? If you take a look at the comments that we had from Governor Macklem, let me just see. He said that present interest rates is approximately appropriate. So that is central bank speak for saying, hey, we think we're done cutting rates for now. We've done what we can. There's only so much we can do from a policy point of view to stop the bleeding. The real problem here is on the trade side. So in terms of that, what could be the biggest surprises? Now, one could argue that if we were to get another very strong print for this week's data, that could provide some compelling upside for the CAD in the very, very short term, because the currency is right now already very stretched to the downside, and from a positioning point of view. So if we were to see another very solid print, because let's face it, the last one that we had was a really solid print coming out for Canada. We had 60,000 added on the headline, but more importantly, full-time employment jolted up by 106,000. That was massive. So if we were to get something that comes out similar to this print, another big jump in the headline, another big jump in full-time employment, that could create some short-term upside opportunities for the CAD. Vice versa though, with labor slowing, with growth slowing, with the trade situation still bleak, I would potentially want to look for more downside in the Canadian dollar right now, not upside. If we were to see full-time employment completely reverse that jump from September, and if we were to see headline, not just pushing into negative, but taking out those lows that we had from August, if we were to see a real massive deceleration, that could be enough for the markets to start pricing in another cut from the bank, right? Even though they said they're done, can they really ignore a labor market that is falling off the cliff? I don't think they're possible to do. They would be able to do that. So my preferred situation would be a massive negative number, and just to press those Canadian shorts a little bit longer, because the situation for them is pretty bleak. Is pretty bleak at this stage. Now, some of the other data points we've got coming up in the week that is worth watching, but something not something I'll be looking to trade, is Swiss CPI data. Look, Switzerland has a deflation problem. We've known that for the last year and a half now. Has it phased the SNB? No. The SNB is basically, they've given themselves an out because they've said, hey, even if inflation moves a little bit up or a little bit down, we think it ends higher in the next couple of quarters. So we're just going to do nothing with policy from here on out. So that's basically, they've disarmed the markets from a rates point of view, because inflation would need to move down so aggressive for them to want to cut rates again. It almost feels impossible for us to get there. But I think the best case scenario for a possible trade would be if we were to see headline inflation not only move back into negative territory, but take out the prior cycle lows, which comes in at, let's just say, negative 0.1. If we were to see that, if we were to see like a negative 0.3, negative 0.4, something really ugly and very deflationary, that could provide some downside for the Swiss franc. And from a dollar point of view, I would like to look for some upside there in something like the dollar Swiss franc as a possible trade. Maybe even Euro Swiss upside if that's the case. But that's really the only opportunity that I would look for when it comes to Swiss inflation data. It's just been such a hit and miss when it comes to reactions. So that is what we've got coming up in the week ahead. It's going to be a busy one, but like I said, from an immediate point of view, we'll be keeping a close eye on those Fed speakers this week. I think that could provide some real good opportunities, getting a sense of where the participants are sitting in terms of their expectations for that December meeting coming up. So with that said, hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know. All right, welcome to a brand new week ahead, everyone. Before we get stuck into the calendar for the week ahead, let's just quickly take a look at where we finished last week across the major asset classes. For the dollar, it was a pretty solid week last week. We finally saw the dollar index manage to break above that very key level of resistance between the 93.30 as well as that 99.30 and 99.50, which basically kept the dollar index at bay since the early parts of June. We were able to break above that level. There was a couple of key catalysts that pushed the move higher. The first initial one, of course, was the FOMC policy decision, where the Federal Reserve came out a little bit more hawkish than what the markets had anticipated. Coming into the decision, the market was expecting the bank to solidify the idea that we're going to get another rate cut in December. Instead, though, what Fed Chair Powell explained is that, listen, that December expected cut is not a done deal by any means. And he basically explained that the cut that they did last week was just a type of insurance-based cut. And going forward, because they have that huge lack of economic data, there's a lot of dissension among the FOMC members right now. Some of them called for a 50 basis point cut, which in my opinion was more politically motivated. And then, of course, there was others like Schmidt, who actually came out saying that he voted for a hold, saying he didn't think they should have cut rates because they don't know where the data is currently sitting. Now, as a result of that hawkish shift from the bank, we did see rates pricing price out a little bit of those cut expectations for December, but the markets are still sitting at about a 69% probability favoring a cut versus a hold. Now, that means for the upcoming week, and we will touch on that in a second, central bank policy comments or comments coming out from the FOMC will be absolutely critical for the week, but we'll touch on that in a second. Apart from that, we also had some positive news coming out between the US and China in terms of that trade truce that was announced, and all of that basically just conspired together to finally see the dollar push above that very key level of resistance. Now, I am currently still long the dollar at this stage. I'm not sure how long I want to be holding this position, to be honest. It is one that has been running for quite a while. I do think there could be more upside in store for the dollar. The initial target for me for the first two units that we took off was that 99.30. Now, we got there a couple of weeks ago. I'm just going to let this one ride a bit and see what we can squeeze out. It is currently at break even. I will most likely just be moving that stop up throughout the week as we start pushing above, especially now that we've cleared that very key level of resistance. Apart from that, gold, very popular symbol over the past couple of weeks, especially when, we hit all-time highs, which seems like every single day for such a long time. And then all of a sudden, as